Hello and welcome to the show. I'm Puneet Wadhwa, and today we have Andrew Holland, CEO Avendus Capital Public Markets Alternate Strategies, with us to help us better understand what lies ahead for the markets in summer 2078. Welcome to the show, Andrew.
Thank you very much for inviting me.
So how do you see the global equity markets play out in the next 1 year? What are the risks to the rally, and are markets pricing all those risks in right now?
Yeah, it's the toughest question I think we're all thinking through. There's many headwinds out there which markets are completely ignoring, ranging from higher commodity prices through to the supply chain problems, higher inflation, margins being eaten into by the input prices. But liquidity is just still king, and whichever way the market looks at things, it tries to kind of say we'll have a Goldilocks scenario. But I do feel that there's a market correction coming now, whether that's before the end of the year or early next year. But I think the fact is that we're going to have to live with higher rates at some point. And the markets have only been fed for since the financial crash really in 2008 with liquidity. So if you're seeing downgrades already to global growth, the question mark, I think, with higher rates, higher inflation, is what can governments do or central banks do to get growth going again? So I think it could be. I think 2022 might be a little bit more trickier for developed markets rather than emerging markets. But China slowing down has got to have an impact on global growth, and we're starting to see those forecasts being brought down.
So what are return expectations from the Indian frontline indices, the Sensex and Nifty, over the next 1 year?
India has a number of good tailwinds behind it. I think this the problems or the regulatory issues, stemming from China, I think has really helped India in terms of again putting us back on the map as a country where we can manufacture or do services which will help global supply chain. So I think that's the one good news. I think two as well is that the retail investor in India has really picked up. I mean, even during the pandemic, the SIPs didn't slow down at all, and if since then obviously they've picked up. So that's a very, very strong sign that people are investing wisely over the markets going up and down. So I think ours will be continue to be liquidity driven because of the retail interest in the markets. But I think our earnings growth will continue to be strong. Yes, there will be certain industries which will be hit because of margin pressure and input pressures in terms of the supply side issues that we're seeing. But by and large, we've got a whole new range of companies coming to the market, particularly in the kind of technology stroke disruption. And I think that will keep our markets alive and interesting for foreign investors, which maybe have now been shut out of China for some time.
But talking about retail investors, Andrew, isn't there a risk? Because most of the retail investors over the past 18 months would have seen a secular bull run. They haven't tasted a fall like we had back in 2000 or the global financial crisis yet.
Yeah, that's a very good point, and obviously we'll see how that tests and how they're tested. But what I was encouraged about was when the market fell that kind of 30% when the pandemic happened. The SIPs by the existing retail investors continued apace. They didn't really slow them down. So that was a really good news that I think. So yes, you will get corrections, don't get me wrong, and it will test, I think, some of the retail investors. What I think it always tests the most, Puneet, is really, those small and mid-cap companies, where there was no strong fundamentals behind them, but obviously, they caught the market fancy. And we're seeing many of them, right, kind of, going up 30 to 50% in a very, very short period of time. And I think that's where a lot of retail investors get hurt, is when they move from, being in a systematic plan through a mutual fund to speculating a little bit more in the individual stocks.
Sure.
But I don't see that as being such a big setback, for retail investors. but it will be painful at some point.
Sure. So in the Indian context, Andrew, would you say that there's too much money chasing too few stocks?
Well, certainly if I look at the large caps, I mean, you have been seeing that rotation and concentration in certain companies. And I think that, that will probably continue to some extent. But I think, if I was to look into next year and think about what I want to do, it's not necessarily that I want to be, for example, if you take financials, it's a big overall sector. We all think about private banks. But, I think there's going to be themes played out in insurance and asset management, which are not necessarily the NBFCs, which I think will kind of be the new areas of kind of growth in terms of, the sector kind of movements within that financial sector. So I think it's going to be a little bit more theme based next year, in terms of picking your right sectors, rather than just saying it's a financial sector, private banks. I think there's some other areas which will start to kind of unfold, and you'll see good performance there. So maybe the index itself, I mean, I'm not saying it won't move up, but I think that there's going to be trends within that index or within the sectors, which will give you better returns going forward.
So what would those sectors be, Andrew?
Well, I mentioned two of them. I think asset management and insurance will definitely be an area which I think will do very well over the next 2 to 3 years. The one area which I think once we reopen to the outside world is obviously the whole hospitality kind of industry. And I was interested when Tata took over Air India, and I'm just thinking in a year's time, Puneet, when we're traveling, when maybe our relatives from anywhere else in the world is traveling in Air India, they'll probably be inundated with offers to stay at the Taj, right, or some part of the Taj hotels. So these kind of new themes, I think, are going to start playing out as well. But I'd certainly think,
Sure. So talking about corporate earnings, Andrew, given the fact that the prices of key commodities such as coal, oil, gas, they're all on an upswing, are we looking at a couple of quarters of earnings downgrades instead of earnings booming?
I think we could see some downgrades to the projections that we have. And it'd be interesting as we're in the reporting season now to see what corporates are saying about the input pressures or the supply chain pressures which they're facing, and can they pass that on to the end consumer or business if it's a service. If they can, then earnings will continue to do well. But I would have thought you will see some pressure on margins and downgrades. So what will happen, I think, Puneet, is the analysts will do their usual, which is maybe downgrade slightly, but then upgrade 2 years on, right? Which is always so to justify the kind of ratings which they have for these companies. So I'm a little less worried about the downgrades, because I think it's going to happen. It's going to be a global event. I don't think it's just going to be an India event, and therefore that's where you get that overall global correction, of which we might also have that kind of correction at the same time. But thereafter, I think that the good news for India is that the government spending is really yet to kick in. So that's the added kind of extra bonus for GDP growth, and the multiplier effect will be significant. And I think all of these new disruptive type companies come into the markets. I think again is a theme that will be played in India. And I think whilst I look at the kind of indices and think about PEs, I think we're going to have to live with a higher PE than we have in the past.
Correct. Yes.
Because I think there's a lot of growth sectors out there which will keep the indices PE a lot higher than we're used to.
Sure. So we've spoken about retail investors. What about the big daddies in the market, FIIs? How are they viewing India within the emerging market context and the overall allocation they want to make to India in the next 1 year?
They like the India story, that's for sure. But you haven't really seen a lot of, kind of long only funds, see a lot of, inflows into there. So it's been mainly, I think, through the ETFs, getting exposure to India. But if you think about China slowing, you see, our theme is more around Asia, but if China's slowing at the moment, then the likes of Japan, Korea, are all going to suffer because they're big exporters to China, whereas India is still a domestic-driven economy. And if we can attract the foreign direct investment into new industries, which the government's doing a good job of attracting those companies, then you'll get that extra kind of fillip for GDP growth. So I just feel that the kind of outlook for India, in terms of the earnings growth and GDP growth, we're still at the early stages, to my mind, over the next 2 to 3 years. There will be bumps along the way, don't get me wrong. But I think the overall outlook within the emerging market context is you're going to have strong growth, domestic growth, and you're going to have new disruptive and high-tech companies coming to the markets. And I think that's what we're seeing actually already by foreign investors coming into the private equity market very, very strongly, much more than they have done in the past.
Sure. So one last question, Andrew. What would be your advice to the retail investor for the next 1 year? Trying to temper return expectations or go all in because we are still in the middle of a big bull market?
Yeah, Puneet, it's a great question because you meet so many people who, as you said previously, have only enjoyed a one-way market. It's been very, very strong. I think the way I think about it, and when I speak to these people, is these investors, is that traditionally, if you look over the last 10 years, your growth rate has been around that 10 to 12%. So if you think about that. And if you get anything better, that's great. But if you can aim for that, think about that 10 to 12% of your nifty kind of compound growth rate. But there, within that, if you can find those sectors and companies which we talked about, which will deliver a lot faster growth in terms of returns as well, that's the way to think about it.
Thanks a lot, Andrew. Thanks so much for your time.
My pleasure, and thank you for inviting me.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.